So in part 2, we're going to concentrate more on the fundamental analysis piece. How do we analyze a company to get an understanding of its potential? So let's kind of move on, right? So we want to look at financial condition. We're going to look at some competitive positions. We're going to look at the composition and the growth of their sales. We're going to look at profitability, asset mix, financial mix. This all comes under a term referred to as financial analysis. So a value of a stock is influenced by the financial performance of the company that issued that stock. It kind of makes sense, right? I mean, we want to understand what is making the company do the things it does. Are those things productive or are they not productive? So we're going to interpret some financial statements. We're going to be using tools called financial ratios. And again, this is very time consuming. One of the reasons I think why you probably don't want to invest too much on your own. You need to hire a professional, somebody that has a team of folks who can do this job for you. And it's it's well worth the price paid for good financial analysis because it's time that you can do other things. You can spend time with your family in social events. You can spend your time working to earn more money, to invest more things. So that is essentially one of the details I think that I emphasize when I talk to people about investing, is that you need to hire a professional, somebody that really knows what they're doing and have the resources to get information. So what is a balance sheet? A balance sheet, very, very simply, is a picture of the company at one point in time. What is it that the company owns? That's referred to as assets. This is cash, equipment, land. What are its liabilities? Who does it owe money to? What are the debts that the company has acquired in order to purchase some of the assets above? And then equity is what the shareholders have invested. This is the money that was invested by the owners of the company. Sometimes it's referred to as common equity. Sometimes it's also referred to as net worth. So what are we looking for? When you're looking at a balance sheet, what are the things that you're trying to see? We're trying to see relative amounts. Are the amounts we're looking at too big or too small? Are there any trends? Are those trends of the variables that we're going to be looking at, of the line items, are they improving or not? You know, how is the company utilizing the tools that they have to show us their position? What do they look like on this very day? So here we have a picture of a balance sheet. Here we see here are the assets. These are all the things that the company has purchased. And I very simply like to refer to this as, this is the stuff the company bought in order to do its job. It has cash, it has inventory, it has some receivables, it's sold some things to its customers and hasn't received payment for it. So somebody owes us this money. And this small piece here is what's referred to as current assets. All of these things will be cash in the next 365 days. The non-current assets are plant and equipment. These are the big ticket items. So this company has a total amount of assets on 2013 of $941 million. Obviously a fairly big company. So the next question we have, these are the assets that they've purchased. The next question is, where did they get the money to buy all of these things? Well, there are only two places they can go. They can either borrow the money, liabilities, or they can get shareholders to invest, which is shareholders' equity. The debt portion can be divided into short-term and long-term. right? Current liabilities will all be paid within the next 365 days. And then long-term liabilities are those things that, obviously by definition, have a very long lifespan. They might be 30-year debt instruments, or anything certainly more than 1 year fits into that category. So of the $941 million of assets that they've purchased, they have borrowed $646 million to pay for that. And you can see roughly that's what, 600 divided by 900, that's roughly about 2/3 of their money has to buy assets has come from the borrowing aspect of the company. The shareholders, on the other hand, have invested roughly $294 million. So $300 million divided by that $900 million obviously says that they have acquired about 1/3 of their money from their owners, and about 2/3 of the money comes from finance people. So just looking at this picture without delving too deeply into it, you say that this company seems to borrow more than they get from their owners. They don't seem to be ashamed of borrowing. Is that a good idea or a bad idea? Well, now we have to ask more questions. Let's look at revenues and expenses. Let's understand something about the profits of the company, the money that's left over to be distributed. Right? So what are we looking for? Again, we're looking for relative amounts. We're looking for relationships. Are the expense items growing faster or slower than what the revenues might be growing? We want to understand that relationship. And again, we're always going to be looking for trends. Are things getting better or are things getting worse? So here's an income statement for this company. And again, we can see here that they have revenue of, again, these are in millions. So this is $1.9 billion is their revenue. Cost of goods sold, what did it cost them to make their products? It cost them $1.1 billion. So that means they have $809 million left over. That's what's referred to as gross profit. So it looks like, again, almost $2 billion. They have a little bit over $1 billion in cost of goods sold. So it's in the ballpark of around a little bit more than maybe 50% of their cost of every dollar goes into producing the product. Selling administrative expenses, right? So the total expenses of running this company is $574 million plus the $1.1 billion up here. So their total expenses is essentially almost what it looks like $1.7 billion. So what do they have left over? Earnings before interest and taxes. This is sometimes referred to as operating income. So they have $235 million left over. Well, who gets that money? Well, there are 3 individuals or 3 entities that can get this money. First, they have to pay their creditors. They owed them $13.4 million. That left them with $221 million. The next person they had to pay was Uncle Sam. They had to pay taxes. So they have $821 million in taxes. What this means is there's $139.7 million left over after they've paid everybody that they owe money to except for their owners. So of this $139 million belongs to the owners of the company. The management of the company, the board of directors especially, is going to figure out how to distribute that money. If you divide 139 million by the number of shares, 61.8 million, there's $2.26 is the earnings per share. That is money. Every share of stock has earned $2.26. Now the company has decided to pay 15 cents in dividends. So that means of the 226, they paid 15 cents. So that must mean that $2.11 has been kept, right? This is paid out. The remainder, the difference is what is kept. Where does that money go? Where does the kept portion go? Well, if we scoot back up here, retained earnings is the amount of money that the company has earned but has not distributed to shareholders. So it's shareholder money that's been kept back. So retained earnings is a source of financing. It's a way that the company gets money from shareholders to continue to buy assets and grow the company. What about something referred to as the statement of cash flows? We have a statement, this is actually a very important document, that tries to identify where the cash goes in the company. And there are essentially three important numbers that we want to look at. But we're really looking at where does the company get its money, and then how does the company use its money. What we're looking for, again, is always the relative amounts. We're looking for trends, but in this case, we're also looking for liquidity. How much cash does the company actually produce during the year? So here we have a statement of cash flows for Universal Office Furnishings, and you can see here the net cash flow from operations. This company this year has generated $202 million in cash from running its office furnishing company. Now you can see that that's down from last year. How did that go down? Well, they have less earnings. Now they have more depreciation. They have less in other non-cash charges. But these increases, these changes here, have generated a little less cash than last year. A little bit less than a little bit more than $2 million. The next line item to look at then is investing activities. How does the company invest? What kinds of things do they buy and sell? In this year, you see, this is a negative number. They spent $150 million buying plant and equipment. Last year, they only spent $90 million doing that. So they have increased the cash outflow from their investments. So they have a little less cash coming in. They have more cash going out here. The third category to look at then is financing activities. How does the company finance? What does its debt look like? What are its interest payments? How are its dividends paid? We want to look at those decisions, those activities, and see how it impacts cash. Last year, they spent $150 million on financing. This year, they only spent $35 million net in cash flow financing. So that means what? They have got a little less cash coming in, more cash going out here, but less cash going out here. So what is the net effect? Well, last year, they actually had a net decrease in cash of $35 million. They spent more money, obviously from savings. They spent more money than they had come in last year. This year, it's $15.8 million positive. So this year, they've been able to generate more cash for the company. And you can see it went from 80 million in the beginning of the year, and at the end of the year, they ended up with $95 million. So this cash flow statement is a very important statement to look at three primary activities of the business. Is the business generating cash? Are they able? How do they expand operations? What is the buying and selling of assets? And then in the end, how is cash impacted from financing? Lots of places to find financial ratios and find financial statements. You can go to a company's annual report. Although lately companies are actually producing less and less of these, and they're actually producing what are referred to as 10Ks. These go to the Securities Exchange Commission. But if you go to a company's website, which we're going to go to a company's website and see what's there, we're going to ultimately find what's referred to as either a 10K or an annual report, and that's where we're going to get information about the company. So the next step then, now that we have financial ratios, we want to talk financial statements, we're going to talk about the ratios. What are the relationships between the different line items of these financial statements? The idea or the purpose behind this is to try to get a relative picture, right? If I guess a good example of this was, how much cash do you think Kroger's has in its cash register in all the Kroger's in the world? I would be willing to say it's a fairly large number. They have a lot of cash on hand at each store to maintain business and keep things moving along. Let's compare that number. I don't know how big a number we want to pick. Let's say it's $10 million. Let's compare that to how much cash there is in John and Mary's convenience store located in beautiful downtown Maysville, Kentucky. Never been to Maysville. I don't know how big that is. But it's a one mom and pop store, obviously very little. They may only have $1,000 in cash at any one time. So is it fair to compare the 10 million in Kroger to the 1,000 in John and Mary's convenience store and get any understanding of how that means? And obviously the answer is no. There's no way to use that relationship. But now when we use ratios, when we put them in a quotient form, we're looking at their relative size compared to something else. And when we do that, we can then look at the history of the company. What is the trend of the company over time? We can then look at some industry standards. There are publications that we can go to find out what the average company in the industry does. Obviously, we would like to compare our company to the industry. We want to be above average if we can. So the major groups of ratios, we'll talk about these as we work our way through this chapter. We're talking about liquidity ratios. What is the company's ability to pay its current bills? Can it pay bills? I think it's a very logical question, right? Do you have enough money in your checking account to pay the bills that you currently owe? Activity ratios look at how the company is actually doing its business. How is it managing the amount of assets that it has? We'll look at leverage ratios, talk about the amount of debt the company has. Profitability measures how successful the company is in creating and generating profits. And in the end, we'll look at what are referred to as some common stock ratios. We're going to look at some per share analysis. So let's jump right into this before we don't want to spend too much more time talking about this. We'll talk about liquidity ratios. How much cash does the company have to pay its bills? Current assets, if you remember, we talked about it. All of these things will be cash in the next 365 days. Current liabilities are all the debt that we owe that's due in the next 365 days. So this essentially is cash divided by debt. Do you have more cash than debt? Obviously, you want a higher ratio. This shows more liquidity, a greater ability to make payments. Lower obviously means less liquidity. Net working capital really comes back to what I was talking about before. It says, what is just the net number? Current assets minus current liabilities. As a company, do you have enough net working capital to function, to pay your bills, and then to have maybe some money to do make some decisions, etc. So higher amounts make the company's investment in short-term assets higher. It's a good sign. companies with high liquidity seem to have or tend to have less risk. Now again, we don't want to compare this number to another company because it's really meaningless because we're doing dollars to dollars, but we would like, just as a quick and easy number, to know whether a company has enough to pay its current bills. Next, we want to switch to activity ratios. How well does the company utilize the assets that it has? So the beginning activity ratios talk about short-term assets. Accounts receivable turnover. How quickly is the company collecting its accounts receivable? And if you kind of think about this, it's how many times a year do we get paid for the debt that we owed? A higher ratio is better. It means we're giving or selling assets, selling our services or our products. We're selling it for debt as credit, and people pay us back. How frequently does that happen? How long does that happen? A higher ratio is obviously better. A lower number is worse. Inventory turnover. Again, how quickly do we convert inventory into sales? Again, a higher ratio is better. A lower ratio is worse. And we want to obviously we want to produce products and we want to sell them. The quicker we can do that, the more often we can make money. And the last of the ratios to look at here is called the total asset turnover ratio. This looks at the entire picture of assets, not just short-term assets, but also our long-term assets, because now we're looking at total assets. We want to be able to generate a great amount of sales given our total assets. So the higher this ratio is, the better the company is. The more efficiently they're using their assets to create sales and provide revenues to the company. So we're going to move on then to part 3.